Rethink Investing has rebranded and restructured into Rethink Group, uniting 7 specialised businesses to become, well, a dominant force in the Australian property sector. And to talk about that and what's ahead, Chief Executive Scott O'Neill joining us now. Scott, welcome.
Thank you, good to be here.
Why the rebrand?
Look, when I first started the company, it was about 10 years ago, and I think I paid $10 for a GoDaddy logo back then. So the company's come a long way since then. We've helped over 5,000 clients and purchased around $5 billion in property in that time. So we wanted to reflect the maturity of the business, and we are going more like corporate level. A lot of our clients are institutional type clients these days, like family offices and high net worth individuals, as well as all the mums and dads of the world are still investing with us. But yeah, we thought it was time to kind of reflect where we are as a business.
Can you just describe that journey to us over that time then, in terms of moving from providing, I guess, property financing for individuals, and now, as you say, you're talking to institutions, much bigger deals, but beyond that, you're also, what you say, you're focused on a holistic approach to wealth creation. Talk us through that.
So started off with the buyer's agency business. That was, like I said, about 10 years ago. And, all these businesses were created to solve a problem for a client. So the problem was initially finding high yielding property. It started in residential, found it was getting harder and harder to get high yielding in residential. So we moved into commercial, split those two businesses into residential and commercial. And then when we started dealing with commercial, we found it was very hard to get good finance advice on commercial finance. So an easy solution was create our own. And then the same thing happened with insurance. We found a lot of the insurance type brokers out there were just so used to residential or specialist business advice, but not the properties themselves. So again, every business was there to, I guess, solve a problem for a client. But then as those businesses grew in maturity, they all started growing at different speeds. And that's where we wanted to kind of get them back into one umbrella. And they're still individual businesses, but they operate, with the same mantra, and most of the clients end up wanting to kind of be kept in that ecosystem where they're looked after holistically, and that allows them to build wealth safer that way as well.
So what you say, you're sort of servicing that gap in the market, if you like. So what? You mentioned financial, insurance, what, legal as well?
Legal. We've got Rethink Renewables, fascinating business that involves boosting the income for commercial owners using solar, battery storage and EV charging. Because obviously you can use the electricity, pay rent for the leases on the roof, you can store that power in the batteries, and obviously you can help with the EV charging, and that's all creates extra rent for the commercial owner, which boosts the yield, and that actually boosts valuations as well. And we've got an online education course, because again, that was another gap in the market. When I bought personally my first commercial property, there was just no good advice out there. Like I found books in America, there was really nothing in Australia that was relevant to Australia. So we've done the book thing, but we wanted to go one step further, and that's where there's about 60 modules, and it gets one of the best property managers in the country, best lawyer, best, all the experts come into it. And by the time you get through that, you're basically an expert with commercial, or at least, you'll know more than 99% of the population. And education's the key. So it's a vertically integrated business model, but it is servicing a big gap in the market, and we've been growing about 30% per year for the last decade as a result.
Scott, let's take a look at the market as it stands at the moment, maybe splitting it. First, residential, and we know that the government has that target of building 1.2 million homes by the end of the decade, although it's sort of been stymied at the moment by, obviously in terms of resources, finding the labour force to facilitate that, and also problems with red tape in terms of approvals. What about in terms of financing? What opportunities are you seeing there?
Well, look, the residential market's really fragmented at the moment. Like if you look at the last 12 months, the best market was Perth, growing at around 22.5%. The worst market, Melbourne, -2%. So huge differential. And that's going to be the key as we move into 2025 and onwards. There's going to be just markets moving at different speeds. Affordability constraints, like you mentioned, finance, is going to be an issue because the rate cut's not coming as quick as we once hoped for. So those that are hanging on by a thread are probably going to think about selling sooner now, rather than holding out and getting through by the skin of your teeth. So it's going to be a mixed year, but I think there's a lot of opportunity because many markets are growing at record speeds. The vacancy rates across the country are terribly tight, so rents are going up. many markets double-digit returns. This is for commercial and residential, and if you get it wrong, you're going to get it really wrong. If you get it right, you're going to do very well. So it's not like one of the markets of the old where everything kind of moves at similar rates. It feels different this time.
So what are you seeing with property investors at the moment? And you mentioned obviously the prospect of rate cuts seems to be pushed further and further across the horizon here, locally at least. Are some struggling to service their debt? As a result, are you seeing some forced sales and therefore perhaps seeing some buying opportunity?
Yeah, look, it's a mixed market again. If you look at the top end of the premium market, they're just buying with cash, so they don't really care about the interest rate. And then you've got this middle market, which is getting hurt the most. They're the mortgage belt of Australia, where they've got high leverage. It's generally a family home where the stress has been felt more. The investors have just pulled back, like markets like Victoria, they've pulled back significantly, and that's why you've seen so much supply on the market, and that's caused price falls. Other markets like Brisbane, it's tight. Down in Adelaide, it's tight. So yeah, mixed bag, but I'm seeing opportunities in even the unit market. We don't talk about the unit market a lot, but because that's more affordable, interest rates staying higher for longer, affordability is going to be a growth driver. So I like any capital city or major regional centre that represents an affordable purchase relative to incomes. They'll be the ones that outperform the ones that are struggling with the cash flow issues we're seeing.
What are you seeing in commercial property at the moment in terms of that opportunity?
Yeah, there's a few. So the industrial market is just white hot as every time
for the last couple of years,
this,
hasn't it? Yeah, whereas obviously office and retail really struggle.
Yeah, so there's a subsector in retail, which is where the opportunity is, the neighbourhood shopping centres. You know those little freehold properties where you get an IGA, might get a Domino's, a dentist, all that kind of stuff. They're actually yielding better than they were 2 years ago. Investors are now targeting them very hard because the businesses that have survived the last 4 years with COVID and everything that's happened after that with inflation, generally are pretty good tenants. So you can get the security of multiple income with a good freehold property, and it's priced well, because one of the issues with industrial, because it is so strong, it's priced well. Investors haven't sold off. All the fund managers, there's articles out every day talking about how bad the office market is. CBD office market, by the way. But the industrial, those same funds are holding their industrial, so there's really not many transactions happening. And that's kind of pushing the prices up, because when one does come available, people fight hard for it. And me as an investor, I don't want to pay top dollar. I want to get a good deal. And seeing retail, because of that assumption that all retail is bad, is one of the opportunities you should focus on. Counter-cyclical investing is a good thing. Childcares are another one. They used to be priced at 4 to 5% yields. You can now get those 6.5% yields if you know where to look. These can come with 15-year leases, brand new properties, ASX-listed companies, good strong assets. So to get that above 6% with depreciation, you need 4 or 5 million to get it, so it's not cheap, but some good numbers out there.
What do you look for instance, when you're scoping for commercial opportunities there? Is it those areas that perhaps presenting strong population growth?
That's one of them. Or even stable population growth, because imagine you own the only shopping centre in an area. It's an LGA you're looking at, local government area. So you don't need to be in a massive city, because if you're buying a shopping centre in Campbelltown, it doesn't matter what's happening on the northern beaches. It's kind of just what's happening in that 5K radius. So you've got to drill down into the local specifics, and those opportunities can take you anywhere.
And Scott, you're also in New Zealand. Now, of course, they're ahead of us in terms of the rate cutting cycle. They're well and truly underway there. And of course, the economy has been struggling. What are you seeing both in residential and commercial?
I'm loving New Zealand at the moment. As mentioned, I've run this business for 10 years and I haven't seen a market like New Zealand since probably just after COVID hit us back in 2020. Because remember what happened after 2020, interest rates dropped and the market just went through the roof. That feels like New Zealand now, because they pushed their official cash rate to 5.5% versus our 4.35%. So they got hurt a lot and their prices fell. We're seeing up to 30% corrections in some areas. So if you go back in any market in Australia, if you went back after a market corrected by that amount, very few have ever done that, by the way, and bought at that low point, you're probably going to do quite well. They've had multiple rate cuts. They're expecting about another percent, and it's going to bring it down under Australia's interest rate soon. but you're getting really good yields, ones that you wouldn't have got 2 years ago. So it feels like one of those special markets that it's not going to be an opportunity that's going to last forever, because I know the vendors we're negotiating against are getting more aggressive in terms of asking price. As soon as they see rates cut, vendors are going to want more money because they think there's more buyers naturally, and they're probably right. But that's a good market. We're seeing same things that work in Australia work there. You know, medical, childcare's, any type of industrial that's in a good area that's got a good yield is going to work. So yeah, it's an open book type area.
Scott, thanks for joining us in Rethink Group.
Good to be here.